All right, let's dive into a real head-scratcher that sits right at the heart of financial markets. It's this fascinating puzzle that honestly plays out every single day. You've probably noticed this, right? Stock prices seem to move in a flash, almost like they can see what's coming. Meanwhile, the official forecasts from all the experts, they always feel like they're playing catch-up. So what is going on here? We are going to get to the bottom of it.
Okay, so to crack this case, we first have to lay out the two main clues. And on the surface, they seem to totally contradict each other.
And here they are. On the one hand, you have expert forecasts. The data shows they consistently underreact to new information. They're just too slow. But on the other hand, you have stock prices, which seem to do the exact opposite. They jump the gun, they overreact, and then they often have to pull back and correct themselves. So, how can the market be too slow and too fast all at the same time?
Now, for a long time, the easy answer was to just kind of throw your hands up and say, well, I guess markets are irrational. But a really groundbreaking paper suggests there's a much more elegant and, rational explanation.
Yeah, for years, the go-to explanation in finance books and articles was human psychology. The idea that we're all just driven by greed and fear, and our brains aren't really built to handle the complexities of the market. But what if that's not the whole story?
This new theory says, hey, maybe we don't need to assume everyone is irrational. Maybe we just need to accept one simple, obvious fact. Not everybody has the same information. Some people just know more than others. So let's meet the first player in our little game, the informed investor. Think of these as a small group with a serious edge. They might have access to incredible private data. Maybe it's satellite photos of parking lots or deep dive proprietary research. The point is, they have a secret signal.
And then there's our second player, the uninformed investor. And you know what? This is most of us. We're not irrational, we're just working with what's publicly available. And our biggest clue about what the informed folks are up to is to just watch what the stock price does.
So, how does this dynamic between the informed and the uninformed solve our first clue? Why is the average, the consensus forecast, always so late to the party? Well, imagine it like this. You've got two weather forecasters. One of them gets a top-secret satellite feed that shows a huge storm forming out at sea. They immediately and drastically update their forecast. The other forecaster only sees the regular public weather maps, so they maybe nudge their prediction just a tiny bit. So what does the average forecaster do? It barely moves. It looks like the consensus is asleep at the wheel, when really, it's just being dragged down by the people without the good info.
And get this, the data backs this up in a pretty amazing way. This table shows that when the informed investors change their forecasts, those changes can actually predict when the uninformed investors are about to be wrong. But it doesn't work the other way. Changes from the uninformed tell you nothing about the informed. It makes perfect sense, right? The insider's actions predict the outsider's mistakes.
Okay, so that handles the slow forecasts. But what about the other side of this mystery? Why do prices seem to jump too far, too fast? If the consensus is so sluggish, why is the stock price itself so hyperactive?
Well, the theory says that in between those big, scheduled announcements, like earnings reports, the market is basically flying blind. It's like a ship in a thick fog. And in that fog, the price gets pushed around not just by real information, but by random buying and selling, stuff that has nothing to do with the company's real value. The paper calls all of this random movement noise.
So you end up with this really predictable cycle. An announcement hits, and for a moment, the fog lifts. Clarity. Everyone sees the true value. But then, as time goes on, that fog of uncertainty rolls back in. The random noise builds up, pushing the price further and further away from reality, until, bam! The next announcement arrives. The fog is instantly cleared, and the price has to violently snap back to where it should be.
And here is the beautiful proof in the data. This chart shows an incredibly clear pattern. If a stock's price drifts up in the days before a big announcement, that's the positive bar on the left, that's the noise building up, it actually predicts a negative return on the day of the announcement itself. That's the negative bar on the right. That drop is the snapback. It's the market correcting its own noise-driven overreaction, right on schedule.
But wait, there's one more amazing twist to this story. The size of this overreaction, it's not always the same. Turns out, it all depends on just how thick that fog of uncertainty really is. So during really volatile and uncertain times, when the fog is super thick, a lot more of that random noise gets baked into the price. And that leads to a much bigger overreaction and a way sharper snapback on announcement day. But when markets are calm, when the skies are clear,
There's less uncertainty, prices are less affected by noise, and you see very little overreaction at all. Sometimes, it even disappears entirely.
Okay, let's put all these pieces together. It is time to officially close the case of the contradictory market.
So here's the big reveal. The slow forecasts and the jumpy prices, they aren't a contradiction. They're not even two different phenomena. They are two sides of the very same coin. Both are perfectly rational responses to one single thing: information asymmetry.
Let's just break it down one last time. Why are the forecasts slow? Because the uninformed are rationally waiting to see what the informed do. Why are prices jumpy? Because that exact same uncertainty allows random noise to build up in the price, which then has to be rationally corrected when the truth finally comes out. It's all connected.
The paper's author, Leyla Jianyu, sums it up perfectly. What she's basically saying is, look, we don't have to throw out the idea that people are rational. We just have to stop assuming that every single person in the market is identical and has access to all the same information.
And that leaves us with a pretty powerful final thought, doesn't it? If the market price today already reflects what the smartest, best-informed people figured out yesterday, what does that really mean for the rest of us trying to beat the market tomorrow? It's something to think about.